Hello, my name's Will Trayford and welcome to the deVere live webinar series. This is the 14th webinar in our series and the second time we're coming back to Millennial Investing. And today I'm delighted to be welcoming Joseph Kheng from Providence, who's going to be talking to us all about the tips and tricks that we need to know and the strategies that we need to have in place for millennials. Okay, so before I hand over to him, let me just run through the format for people that haven't joined us before. Okay, so first of all, what we want to do is we want to know what your opinion is and what your current strategy is. Okay, so we'll be doing a poll and getting to find out a little bit more about you, and we'll release those results after the presentation. And then I'll be handing over to Joe, and what he's going to do is going to give you lots of information. He's going to go through a presentation, and while he's doing that presentation, I'm sure that you can have lots of questions. Okay, so for those that haven't joined us before, at the bottom you will see a chat box. Okay, in that chat box, what you need to do is select all panelists and attendees, and then put your question in, and then we can all see your question pop up. And what I'll do is I'll ask those questions to Joe after his presentation. And the good thing about putting all panelists and attendees is that other people can see your question. It will inspire more questions, and it just creates a really good environment in the webinar. Okay, and then after we've done the Q&A, what we'll give you the opportunity to do is take that information and say, okay, I want more information, but also I want to know how to put that information into action. And we'll give you an option to reach out and tell you how that you can do that. Okay, so with that, let's start the poll. So let me get this one in the right order first of all. So what percentage of your income do you currently save? Okay, think about your income, whether it's salary or otherwise. What percentage of your income do you currently save? Is it none, 0 to 10, 10 to 20, 20 to 30, 30 to 40, 40 to 50, or 50 plus? Okay, so just put your answers in there and we'll release that after the webinar. Sorry, after Joe's presentation. Okay, and with that, Joe, do you want to turn on your camera and turn on your mic? So Joseph Kheng is the account executive Asia at Providence Life, and he's going to talk to us all about millennial investing, a fellow expat and millennial. So over to you, Joe.
Yes, definitely, certainly a expat and millennial indeed. Yeah, so basically, I'm from Providence Life, which is a company that I've worked quite closely with deVere for a number of years. We've been around for about 12 years in operation, and have just under $1 billion USD under management. We're headquartered in Dubai, and I personally am based in Bangkok. Been here for best part of 6 years, more than 6 years now actually, which has gone pretty quickly. But yeah, we basically look after a lot of deVere's clients, a lot of deVere users, a lot for their clients in terms of using our platforms to invest. So basically what I'm here to do today is just explain what a lot of our clients do, a lot of what me personally I do as a millennial, and then hopefully you can use some of that information and take it away with you and start saving or save more or use a new strategy or whatever it might be. So hopefully we can all retire earlier and have more time in retirement with more money to enjoy. So without further ado, that's another. Here we go. So why do people save? So a lot of people save for obviously retirement planning. They're saving to buy a property, whether that means they're going to buy the property outright or whether they're going to save for a larger deposit so they have smaller mortgage payments, a number of different reasons why it could be. They want to save for education. A lot of kids or millennials these days, I'm sure a few of people in here will have huge student debts. A lot of people want to save up for their child's education so they can so the child doesn't have to go through that sort of crippling debt as they get older, and they can have the freedom of kind of living without that debt hanging over them. And the other thing is to build wealth. People want to build wealth so they can have something to give to their children when they're no longer here, and something for them to kind of inherit essentially. So the big question that everyone always has is, where do you start? How do I start investing? How do I get into it? And there's a few things that you need to kind of bear in mind and take into consideration, basically. So how much should I invest? How do I have enough spare money to invest? Should I be saving money in my personal bank account rather than investing it? What if I lose money? Are the markets too high? Are the markets too low? There's all of these questions that everyone has when they start investing. So my aim today is to answer all of these questions for you, so you can hopefully have the peace of mind to kind of get involved and get investing now, and stop worrying about these factors, okay? So we'll start with how much should I invest, okay? So what's an important exercise to do first is to figure out what your monthly spend is and then what you earn per month. Very important to figure out a good level of how much you should invest. How much surplus cash do you have, essentially? And the idea from there is to build a safety net of cash, okay? So everyone will be completely different. It will be completely different for everyone. Me personally, I have a safety net of around 5,000 GBP. That's what I look to keep in the bank at all times, because then I know if something was to happen, like the coronavirus has just happened, and if I was to lose my job, which I hope I wouldn't, but if I was to lose my job, I know that that's enough money to pay rent for a few months, and living in Bangkok, it's a relatively cheap place to live. So essentially I have enough cash to survive until things get back up and running, or until I find a new job or something like that. So it's very important to figure out what your safety net should be, and to make sure that you have that safety net built up first before you start putting all your money in investments. As you'll see later on, what you don't want to do is put money away that you then want to take out quickly. The whole idea of this is to put money into an investment and leave it there for a long period of time, or for the goal, until you reach your goal, essentially, whether that be £1 million or however much it might be. You want to make sure that you've got that money saved up in investments and you're not touching it, okay? So you've got to find a comfortable amount for your situation. Everyone's different. Some people have children. I personally don't, but from what my friends tell me, and my brothers who have children, they're apparently pretty expensive. So make sure that you're not putting yourself in any difficult situations. Make sure that you've got enough money saved up to support your family, because obviously that's the number one thing, it's the number one priority. You don't want to be putting yourself in a situation where you don't have enough cash saved up. And the important thing with our products, and a lot of products in the industry, you can start from a pretty low amount. In terms of, with us, it's $300 per month in terms of regular investing. And to most people, might seem like a low number, it might seem like a high number, but it's important to know that you can restructure your lifestyle and spending habits in different ways to accumulate for at least that. Ideally, you want to be putting as much as you can in, and more than that, and I'm sure everyone's in a different situation in this call. Some people have a lot more money to invest, or a lot more surplus. Some people might have less, but it's definitely an achievable goal to start with at least that. And there's a few different things that I do in terms of restructuring the way that I spend money and the way that I think about money, to try and get to a point where I can invest as much as possible every single month. So one thing that Mr. Warren Buffett says, and you'll be seeing a lot of this man, you've probably heard of him. If not, there's a lot of good books that he's written, and does a lot of inspiring interviews where he talks about money and how we should act with money. The one thing that he says is, do not save what is left after spending, but spend what is left after saving, which is a very important thing to kind of think about in your head. Really, we should be prioritizing saving more, which I know as millennials, we don't really do that much. I certainly didn't until a few years ago, but it's something that we should definitely be considering more, in terms of, is what's more important? Is it our wants, or is it our needs, essentially? Okay, so a big thing in terms of this is, or one thing that I do in my own right, is I always think, do I actually need to purchase that, or should I wait and see if I still need it in a month's time? There's one thing I read the other week where it's saying, if you want to buy something, like something luxury good, or a new phone, or whatever it might be, maybe wait a week before you buy it in the shop in the spur of the moment, and then see whether you still need it in a week, or if you still want it in a week, or maybe you might not, which is ideally an easy way to reduce your spending. Another thing that I do is whenever I want to buy something, I always make sure that I could buy that particular item 3 times over, essentially. So if I wanted to buy a car, for example, and I wanted to spend £5,000 on a car, I wouldn't buy it until I had £15,000 saved up. Until I could buy it 3 times, I wouldn't buy it, which is also a good way to kind of defer your interest, or defer your kind of want to buy something. It turns it much more into a need than a want. Do you need the new iPhone as soon as it comes out? Probably not. You're probably just fine surviving until yours eventually dies. So it's a good thing to kind of bear in mind, and especially in the way that Warren Buffett quotes it, is it's much more important to save essentially than to spend. Okay. So the other thing that people often ask or often say is, "Oh, I just put money in my bank account. I just put it in my personal bank account. I save it in there, and then it's there for a rainy day." Now, there's a few issues with this. There's obviously not the worst thing to do in the world, but there is a few issues with it, because at least you're saving, so it's better than some people. But the main issue with your personal bank account or retail bank or whatever it might be is that inflation exists. And inflation is something that will kill your money and it will erode your buying power. Essentially, if your money isn't growing in line with inflation, so if it's not invested and growing in line with inflation, it will decrease in value. And what I mean by that is essentially, if you were to have bought, or if you were to buy today, $10 worth of apples at the market or whatever it might be, those same apples with 2% inflation per year will cost $18.11 in 30 years' time. So if you put that into perspective of retirement, if you're looking to retire in 30 years' time or whatever it might be, the money that you're saving today will be worth a lot less to you in the future. Okay, there's loads of different examples of this online that you can look at. One thing is always housing prices. If you look at housing prices 20 years ago, a hell of a lot cheaper than what they are now. But if you were to save that money up to 20 years ago to buy a house in 20 years' time, or save it up today to buy a house in 20 years' time, that money is going to be nowhere near enough to purchase the house that you want if your money hasn't grown at least in line with inflation. So it's really, really important to kind of bear that in mind. And then also the last thing is obviously the temptation to spend. Kind of touched on it earlier. If you want that fancy holiday, or if you want a brand new watch or a new laptop, new car, whatever it might be, make sure that you can buy it 3 times over. If you want to go extreme, make sure you can buy it 5 times over. Or you can cut costs on things like holidays. If you're going to go on holiday, do you need to stay in the fancy suite when you're not going to be in the room apart from to sleep in? Or can you kind of cut costs on it in some way and invest that money elsewhere instead? There's one good quote that I've seen on Instagram and Facebook, and it's done the rounds a couple of years ago, but it stuck with me, was don't make yourself poor by trying to look rich to impress people that don't care. And I think that's something that we all need to bear in mind. I saw something on YouTube the other day where they're asking millennials in America how much debt they were in. Someone said that they were in $7,000, I think it was, of credit card debt, but they were wearing a Balenciaga cap in the interview, which I then Googled, and it's worth at least $400 to buy the cap. So it doesn't really make much sense. Don't make yourself poor, trying to look rich to impress people that don't care. I think it's a good thing that we could all live by, and you'll definitely have a lot more money at the end of it once you realise that that's something that you might have previously been doing or might be thinking of doing. You don't need a fancy car. A car's a car at the end of the day. You don't need a fancy one as long as it works. There's no point in wasting money on a depreciating asset, essentially. Okay. So one thing that everyone will always say is, what if I lose money? I don't want to invest money into the stock markets because I might lose it. It might disappear, which is an obvious concern and something that many people will say. But if we look at history, and if we look at the S&P 500 in particular, it's never lost money over a 15-year period, or never decreased in value over a 15-year period. Okay, you can do this on Yahoo Finance or any other apps or any other finance websites, Bloomberg, whatever it might be. If you set the scale or the time period to 15 years and you scroll backwards and forwards through it, you will always see that the number on the right-hand side, the end number, will always be in the green. It will always be higher than the 15 years previously. And an example of this would have been during the global financial crisis back in 2009. Obviously, huge losses in the markets in general. Even in a 15-year period, at the absolute low of the global financial crisis, the S&P 500 was still up 56% over 15 years, which is about 3.7% per annum, which is definitely more than the 2% inflation that you'd have had if you put money in the bank. And if we look at that even further and go even further backwards, if we look at 20 years before the global financial crisis, the markets were, or the S&P 500 was up 147% in 20 years, which is 3.5% per annum. which is definitely great. That you want to aim for around 7%, I would say, somewhere around that kind of that sort of growth is what you're after. So if you're concerned about losing money, look at the stock market, look at the history of the stocks, look at a 15-year period, because we're looking at having this money in there for a long period of time. We're not looking at investing for next year. We're looking at investing for 15, 20 years, 25 years. Think about how old you are when you want to retire. I want to retire at 50, possibly the latest, ideally. And that's another 24 years away from me. So I'm only 26, so 24 years, that's a long time for my money to grow that I invest now and invest regularly over the next few years. So I would like to think, based on history, over 25 years, my money will have grown. I'm not going to look to take it out tomorrow. I'm not going to look to take it out next month. I'm going to look to leave it in there for a long period of time. And that's the mindset that you've got to kind of have, okay? So if we look at today and look at 15 years ago, if we'd have put money in 15 years ago into the stock market, and I've based these figures off of the lowest dip during the COVID-19. I was trying not to say that throughout the whole of this, but because I've heard enough of it. But if you look at the lowest dip during the recent drop-off in price, this is essentially where you'd be at. You'd still have 90.27% growth over the last 15 years, which would be 6% per annum. And obviously, if we wait another year, hopefully the markets will recover, and that will be a lot higher, the growth per annum. Okay. So if we look at the actual graph itself, this is the last 15 years as of March 2020. So March 2005 to March 2020, you can see that the market has gone up, even though we've had that big decline at the end. The markets are still substantially up from 15 years ago. So as I say, they've gone up around 6% per annum over the last 15 years. So if you are worried about losing your money, this graph here shows two of the biggest financial crises the world has ever seen. So the initial dip at the start is 2009, where you can see a big fall off. And then the big dip at the end is the biggest dip we've probably ever had in history. It's from the coronavirus, and it's still up over a long period of time. So what that tells us is basically markets will recover, and there will be some bad months in there, but there'll be a lot of good months which will override that. And that's kind of the most important thing that we want to look at today, is basically dollar cost averaging. So essentially what that is, and how to figure out whether today is the right time to put money into the market, or whether it should be tomorrow, or whether we should not invest, or whatever it might be. I'm here to tell you that the money you put in over a 15-year period, or however long it might be, will be perfectly safe, hopefully. No, it will be pretty safe. Okay, so it's almost impossible to time the market. That's the key thing. So if someone's saying it's too high, don't buy now, it's too high, it's too low, don't go in now, it's too risky, everyone's selling, it's impossible to time it. No one can. Everyone tries, but no one can do it perfectly every single time. Even day traders or people who trade on a short period of time, they're never going to get 100% of their trades correct. It's impossible to do. The markets move depending on so many different variants. To know them all is a very, very difficult task. And then the most important question, does it even matter if you're investing over a long period of time? Does it really matter when you go in, if it's going to be over, as I say, a 25, 15-year period? As we saw from the previous slide, not really. It's going to go up, hopefully. It never has gone down over a long period of time. So does it really matter if we or when we go in? The answer is essentially no. And dollar cost averaging will prove that to you. Okay, so what is dollar cost averaging? Ideally, the objective is to buy at whatever price, because we don't know if it's going to go up, we don't know if it's going to go down, but we want to be in the markets. We want to be there. We're going to be in there for a long period of time, so you've got to get in there, basically. The whole idea is to just buy. Regardless of the price, you want to be buying every single month and taking advantage of the low prices or the low of dips in the market, and also riding the highs as it goes up. Okay, so you want to basically get your average cost per unit down by buying at low prices and buying at high prices, essentially. So over the course of a long period of time, you'll be in a good position. Okay, so the current market climate is absolutely perfect for it, because it's going all over the place. Some months it's down, some months it's up, and it's great to take advantage of all of those low prices whilst you can do. It's like if if you're going to buy, I don't know, a phone or something like that, or something you buy regularly, let's say, whatever it might be, let's say beer, for example, if the price of beer drops all of a sudden, you're not going to stop buying it. You're still going to buy it. But also if the price of beer goes up, you'll probably still continue buying it if you're a millennial. Or gin and tonics is what millennials drink, isn't it, mainly? But you know what I mean. You want to be purchasing it at all price because it's more of a necessity. You want to be getting in there at all price. So what I've said there is your funds can be down, but your portfolio can still be up because you're buying at the low prices. So my personal portfolio, the funds that I'm invested in, are currently down 11.4% year to date. But my portfolio is up 1.43%. So even though the funds are down, my overall portfolio is up. And that's because I've been buying regularly and buying in all of these dips whenever the markets have been swaying up and down, and taking advantage of those low prices. So when there's a recovery on some of the purchases or some of the trades that I've made, I'll be seeing a lot larger growth than on others, essentially. So if we look at a graph, this is basically from the start of 2018 up till last week, essentially. And every single circle is when you will have, every single circle is the end of a month, basically. So when you would have bought stock. This is the S&P 500 again. I'll use that for all of the graphs in this because it's the most common market. But if you were to have bought at the start of 2018, you can see every single green circle is a trade that you have now made profit on. Okay, it's now gone up a lot. You can see there's a few big dips in there, which will have given you a larger growth than some of the other ones. And all of the red ones are the ones that you will have currently be losing money on, essentially. Okay, so obviously we don't want to lose money in any trade, but that's the way that the cookie crumbles, unfortunately, and some trades you do lose money on. So for example, with that particular illustration, 18 out of the 28 months will have shown positive growth, and as the markets recover after the coronavirus, etc., even if they go down and you purchase more at a lower price, as they go up, those red circles will turn into green circles, and you'll have taken advantage of some of the really low prices that are currently out there in the market. Okay, so I hope that's clear for everyone. The idea is it doesn't matter when you're going in, it's better to be in. If the prices have dropped, it's great to take advantage of them. If the prices are going up, then your money's only going to go up with it. So that's the sort of thing to bear in mind. And over a long period of time, this is only over two and a bit years, over a long period of time, you'd like to see all of those circles be green, ideally, with some of them earning more growth than others. Okay. So if we look at a real, well, not a real life example, but if we look at an illustration of how this is done with more numbers, essentially, we have two investors here. Scenario number one is if you put all your money in at the start, that's the orange line. So if you put $3,500 in at the start, and scenario number two is if you spread that $3,500 into $500 investments, what happens to your money? So if the markets are down, like they currently are at the moment, we saw them go up, then they went down, now they've stayed down for a bit, they'll probably go up again, which is similar to this exact example here. Essentially, the units that you will be buying on a monthly basis will be cheaper, so you'll be buying more units, okay? So if you look at the bit at the bottom, essentially what will happen is if you're buying units at a lower price, and the market is flat over seven months, essentially, so it was $4 at the start, $4 at the end, or £4 at the start, $4 at the end, you'll basically see that the person who put all their money in at the start, it will still be worth the same, versus the person who put all their money in separately will have accumulated more units and will therefore have more overall growth at the end. Okay, so it's something to bear in mind, and it's something that we should kind of take advantage of by investing regularly, especially in volatile markets that we are seeing at the moment. Okay, and here he is, Warren Buffett again. One of the things that he says is be fearful when others are greedy and be greedy when others are fearful. So what he means by that is basically when the markets are low and everyone's selling and trying to get out, you should get in because they're only going to go back up. And if everyone's buying and the markets are sky high, then maybe sell and sit in cash for a bit. But with us, because it's going to be a long-term plan, or we're all planning or we're all thinking about the long-term future, we want to be investing regularly. Okay, and if the markets are low, then put some more in. If you've got some spare cash, put some more in. Okay, so I pose a question to you guys. If I was to give you $100,000, would you rather take 90% growth in 10 years' time or 7% growth a year for 10 years? I was going to ask you to put your hands up, but I can't see any of you, so I'm not going to do that. But most people will usually say when they see this, I'll take the 90% growth. Because 90% is a nice big number, easy maths. 90% would give you $190,000 in 10 years' time. I see Armando has put 7%. He probably knows where I'm going to go with this. So the easy way to figure this out is what if you've got your phone available or a calculator available, or a calculator on your phone available. If you type in 100,000 US dollars, and then you times it by 1.07, and then if you hit that equals button 10 times, you'll see the effects of the compound interest, and it will go up to essentially $196,715.14, which is actually a massive difference when you think about it. Okay, so it's a $6,000 difference, which doesn't sound like much, but it's 3.5% difference, which over the course of 10 years is a pretty impressive amount. And of course, if this goes into year 11, year 12, etc., it only gets bigger and bigger and bigger, the effects of compound interest. So if you do that on the calculator, you'll be able to see it quite clearly. And if you don't have a calculator, here is the maths for you. So you can see the annual interest, the middle column. You can see how that grows every single year. Because essentially what is happening is you're getting that 7% each year on the previous year's growth as well. And then on the previous 2 years' growth, and the previous 3 years' growth, etc., etc., etc. So as you can see, the longer it goes on, the more your money is making for you. And it's essentially, or just nearly doubled based on 7% growth over a 10-year period. Which when we start to look at a longer period of time, it's a huge amount in which it changes. Okay, so here's another one of good old WB, Warren Buffett. He gave his son $90,000 when he was age 19, and that's now worth $200 million. I believe it was from a sale of a house. I think he sold the family farm or something like that, or his inheritance. He gave it to his son, and his son decided to invest it into his dad's company. His son is currently 62 years old. So over 43 years, his money went from $90,000 to $200 million. Obviously, we're not all in that scenario. We don't have one of the best fund managers in the world as our father, or $90,000 at the age of 19. But essentially what that is, to break down the numbers, is a 250,000% growth, which is pretty unheard of. Or it's 18% or 18.05% per year over 43 years. So 18% a year, it's pretty unattainable. You're going to struggle to get that, but it doesn't sound anywhere near as much as 250,000% over 43 years. So it just shows you the massive effects that can have. And essentially, if he was to wait another year, that 200 million is probably going to be worth 230, 240 million, if it grows at the same rate. So yeah, as you can see there, his quote is, "I don't regret it," and I'm sure he doesn't. Will happily be able to retire now. I think he's a musician in his own right, but yeah, he will be able to retire quite comfortably on that. And I would say it's a pretty good decision to invest that. As the story goes, I think his brother and his sister both spent it on holidays, and they don't have anywhere near as much money as Peter, I think his name is Peter Buffett, who put it into Berkshire Hathaway stock. Okay, so if we look at this in a more realistic scenario, and let's say you're saving £12,000 a year, or $12,000 a year, or £1,000 or $1,000 per month, essentially. This is essentially how it would look over the first 5 years, okay? So you can see that your growth and your total investment pot is growing and growing and growing year on year on year. By the end of 5 years, you'll have essentially made 1 year's worth of investment in interest, okay? So by the end of 5 years, you'll have made 1 year. By the end of 10 years, your annual interest will be just over £11,500 or dollars, which is essentially 1 year's annual investment. Okay, this is based off of 7% growth, just so you know, which is what the kind of market average is in the S&P 500 over the last however many years, as we looked at earlier. So what you can see here is your pot's growing and growing and growing. As we get to year 15, you'll have invested £180,000 or dollars and got 142,000 back in interest. And when we get to year 20, you'll have got even more money in interest than you would have put into the plan. Okay, so it's quite a staggering amount of growth over a long period of time, and that is the beauty of compound interest. So long as the market's going up and it's growing, and your growth is growing, etc., etc., you'll be in a very good position later on in life. Your future self will definitely thank you if you start now and stay invested for that period of time. So if you want it in a more visual way, if you look at the graph here, you can see the huge kind of difference, the exponential growth between the two bars. The blue line is your contributions, and the red line is your total pot. So you can just see it gets steeper and steeper and steeper. And obviously this is just 20 years, but if you were to leave it in there for 25 years, it will get steeper and steeper. To the point where you probably won't want to retire, because you'll see your money growing so much you won't want to touch it. But ideally, you'll get to a point where you want to take it out and want to start withdrawing on it, or whatever it might be, buy that fancy house, and live in it, relax for the rest of your life, living off your own personal interest. If you skip back to the previous slide, actually, if you look at the annual interest there of £34,000 after 20 years, that's enough to live off for some people. Maybe not with inflation in the future, but if you were to invest more as you get paid more, as inflation goes up and your pay rate goes up, and you change this from 12,000 a year up to 15,000 a year after 5 years, etc., etc., you will have a huge amount of money to live off, and you can live off just the interest and leave all of the total pot essentially to loved ones or family or whatever it might be, or you can essentially do what you like with it. It gives you financial freedom, which is something that I always see thrown around online. It gives you the options to do what you will with it. Okay, so the last thing that I'm going to go through is something that I hear so regularly. I'm going to start investing next year. I'm going to start investing after Christmas. I'll start investing when I get promoted, when I change jobs. I know in China, especially in Shanghai, I'm sure you'll have all done it, where you say, I'm going to do it after Chinese New Year. I'm going to wait for this, that, and the other. And everyone always has an excuse not to start. So this next slide will hopefully show you the reason why you should start as soon as possible. Okay, so let's say you get 5% growth a year. You want to retire with £1 million age 60. Okay, if you're 30 years old, or if you want £1 million in 30 years, or whatever it might be, essentially you'd have to invest £1,700 per month for 30 years with 5% growth to get to £1 million or dollars, or whatever you what currency you want to use. Okay, if you were to wait just 1 year, okay, if you were to wait 1 year and you wanted to get the £1 million in 29 years instead of in 30 years, you would have to save an extra £100 per month, which would total over those 29 years £14,400 more you would have to save. Okay, sorry, I'm reading the messages as they come up. So you'd have to invest an extra £14,400 over the 29 years. Okay, so if you look at that in an even more extreme example, is if you were 40 and you had 20 years to get to 60 and to get to the £1 million, you'd have to save £3,000 a month. So by delaying 10 years, essentially, if you would really want to procrastinate over it for that long, you'd essentially have to save an extra £1,300 per month, which is a staggering amount more in order to hit that £1 million mark. So each year you delay, or each time you delay, the amount you're going to have to save to hit that goal is going up and up and up and up and up. And that's almost an effect of the negative compounding, the fact that you're not taking advantage of the positive compounding. Okay, so it's something to definitely bear in mind, especially at the moment as the markets are low. You want to be taking advantage of them as soon as possible. As I say, they're only going to recover over 15 to 20 years. If they don't, we'll have bigger things to worry about, I'm sure. Armageddon will have happened or something like that. So they're only going to recover over the next 15 years, and the best time to buy is right now. The best time to start is right now, so you avoid this cost of delay, and you also take advantage of those low market prices. Take advantage of the dollar cost averaging. It will instantly bring down your average unit price, and then of course the compound interest effect will be exponential. Okay, so I'll open the floor to any questions and invite Will back, and yeah, fire away.
Thank you very much, Joe. If you just want to stop your sharing there, and then everyone can see our faces really big, for good or for bad. Yep. So, so excellent. Thank you very much for that. That was an excellent presentation. We've had a lot of questions come in, both offline and online. But what I'd like to do first of all, there's a little bit of an echo there, Joe. Perhaps turn the sound off or something. Is actually release the results of the poll. And actually get your opinion on that. So just share the results. As you can see there, just slightly in the lead is 10 to 20%. And then pretty even split across the board. So on that, what do you typically see, or either through Providence or actually just friends that you've got other millennials? What would you say is a typical percentage of income that people save?
Yeah, I think with a lot of people, they want to save as much as possible, but don't trust themselves to do it, or think they might need that money, or situations like that, or something might come up and they're a bit hesitant about it. Me personally, I look to do about 30% per month. I think that's kind of like the goal really is at least 30%. But I know a lot of people and a lot of millennials, especially some people that I know, don't save any, which is staggering. But a lot of people, I would say, are around the 20% mark. But obviously, if you see with the cost of delay and things like that, the more you save now, the less you'll have to essentially work in the future. That's the way I look at it. The more I can save now, if I make a few sacrifices in my life to save more now, then I won't have to be working as long, basically, because I'll have a bigger pot built up sooner. So then I don't have to work for as long, and that money will then obviously grow for me more. So I look to do about 30% of my personal income.
And has that changed? I mean, is that as your salary's gone up, or have you matured in the decisions you're making?
A bit of both, actually, to be honest. Definitely, I think with the salary going up over the years, costs have gone up, which I think a lot of people see. You move into a nicer apartment, or you have more rent, or higher rent costs, or whatever it might be, or you go to eat in fancy restaurants. But then it's changed since then. So originally it was originally about 20%-ish, 15-20%. And then as the salary went up, I kept it at that. And I thought, actually, no, there's so much money being wasted here. I'll change it and save more. So yeah, it has definitely changed over the years. It's definitely gone up to above 30% from about 10 to 15%. So yeah, it's changed for sure.
It was going in the right direction then.
Yeah, definitely.
So Nana's asked, what online platforms do you recommend to start investing?
Well,
try to take an independent view.
What I'd say about it is there's obviously we provide our own. I know that you guys deVere have your own one. There's 1,000,001 companies out there that have them. It's just about finding one that you're comfortable with, one that you like to use, one that gives you some flexibility, allows you to take money in, take money out, if emergencies were to happen. So yeah, there's lots out there. We have our own one. It's also about finding one at a good cost, one that gives you good benefits. Some give you bonuses, etc., etc. So it's definitely about looking into the market, finding out which one's best. If you ask me directly, I'm going to say ours. But if I was to give an honest answer, you want to look out there and see which ones are the best. Which I know that you guys have all of the information on that, so I know that you'll be able to point her in the right direction, I'm sure.
Yeah, we'd absolutely agree. Of course, it's about fitting the solution to the need.
Yeah, definitely.
One that's come in is Joe's accent from the northeast of England.
It's from Lincoln. Yeah, from Lincolnshire. So I might have a Chinese name, but I only have a Chinese granddad, so I don't look very Chinese. but yeah, I was born and raised in Lincolnshire, so yeah, northeast-ish. We don't like the north bit. We prefer to just be East Midlands. But yeah.
So Olivia's asked. She's actually broken it over two bits just to clarify. So she says, so stock appreciates the same as a savings account. And she said to clarify that question was because the Buffett example was a lump sum. So talking about, I think, the effect of saving on a regular basis, is that having the same compounding effect as a lump sum would? And do stocks, when you think about the interest on stocks or the growth of stocks, does that compounding effect happen in the same way as if you thought about a savings account where you're getting a fixed amount? And then
So the thing is with a lot of savings accounts, I don't know about the interest rates in China, but I know personally in Thailand and in my UK savings account, I think my UK savings account, I looked at it the other day, it gives me 0.15% interest a year or something like that. So that being compounded, obviously it'll have an effect, but it's nowhere near the same growth that you'd be able to get within the stock market or within mutual funds or whatever it might be. So yeah, it definitely compounds in the same way in a lump sum, and it compounds in the same way as in a regular savings plan. So yeah, they both compound the same way. The formula doesn't really change. The more you add contributions in, obviously those contributions then also have a compounding effect. But yeah, if you have a lump sum of money, then definitely get it invested and take advantage of the compounding of interest. That's kind of what I was trying to illustrate with the 90% over 10 years or 7% a year kind of question. So definitely you'll see the growth in both scenarios. But versus a savings account that your bank will provide, you'll probably find that the interest rates in there are a lot lower. I'm not sure what they are in China. I know they're a bit higher in China than most places, and in some more emerging markets like Indonesia, they used to be really high. But in England or in the US or wherever your money usually is, then they're not going to be that high, I would have thought. I don't know what they are in China, do you?
They're relatively okay, but it's not something that expats can access anyway. So
okay, well there you go.
Irrelevant point for us. So actually, a couple of questions that came in offline. What do you think is the biggest challenge for millennials specifically?
I think we have I think there's a few. There's definitely like a perception about us, that's for sure. people think we're lazy or trying to find shortcuts or things like that. And often your kind of ideas aren't really appreciated as much because you're younger, and there's kind of this idea that everything's been given to you on a like with a silver spoon and it's been easy for you. A lot of people always say, you always hear older people say, back in my day it wasn't that easy, it was a lot harder in my day. So you're kind of facing an uphill battle when you from the start. I think is one of the biggest disadvantages. But then that just means you have to work harder in a way. You have to have more hustle and try harder. And I know you'll have seen it with some of your clients and me with some of the brokers that I look after. When you're half someone's age and you're kind of telling them what to do with their money, they kind of think, why is this kid telling me what to do, sort of thing. So yeah, that's one of the biggest things is just that we're a lot younger, but sometimes more further on in our careers than someone else would have been at the same age previously 20 years ago. So yeah, I think that, and then along with that, the other things are just distractions, digital distractions, things like that. I don't think, I think like if you look at the 30 to 40 years population, how many owned a PlayStation, it'd probably be pretty low. Whereas 20 to 30 is probably pretty high. So it's kind of things like that. We have more distractions because of the generation that we grew up in, with the advances in technology, etc. So I think there's a few, but I think it's more mind over matter. I think if you focus on the job at hand, you can get rid of those disadvantages quite quickly.
Yeah. And I know we spoke about it in one of the last ones, but to pick up on it was the analysis paralysis. But actually having access to so much information online and tools to do this can actually be a disadvantage.
Yeah, definitely.
It's almost too much information in some ways.
Yeah, for sure. I think with my personal investments, it took a while to kind of figure out what to invest into. And then once I eventually decided, I was umming and ahhing for so long, thinking, oh, should I do this? Should I do that? Should I do this? And then I realized, in reality, I just need to do something. Instead of waiting. Goes back to the last slide, the cost of delay. Get it into something. And then almost ignore it, kind of just don't look at it. just check in on it once a month or something. Try not to look at it every single day. Because if you look at it every single day, especially in the last couple of months, you'll be seeing it going up and down, all over the place. I think there was one day where mine went down 10% in a day, and I was like, well, this was a bad idea. Why did I do that? But that's when you're looking at it too much to say you've got too much data, you've got Bloomberg on, or whatever it might be. It's almost better to just get started and then just let it do its thing, and then look at it in a year's time and you'll be thankful for it, for sure.
Yeah. The next one, actually, I think I'll quickly address from Miguel. Says, I've always believed in financial instruments. So listening now from you guys, as I would like to introduce your services to friends. Most of them are local Chinese, though. Can they invest with you without losing too much on currency exchange? Miguel, I'll actually ask you to reach out to the advisor who spoke to you before, but also in general, no, we can't work with local Chinese, but exchange rates, there's a lot of ways to benefit from that, actually, and it can actually work in your favor. Here in China. It's one of the good things about being here. But very specific, and I'll say reach out at the end to get someone to contact you about that. And one from Phil, do I have to pay tax on the interest or the growth?
I mean, that depends case by case, really. It depends on where you're located. It depends on where you're looking to kind of take money out, retire, etc. It depends on a number of different things. Best to speak to a tax advisor on that one. I'm not qualified to answer that question because it depends on a number of different things. But our personal plan's based in Mauritius, is where our investment license is. So essentially, depending on what the tax treaty is or the double taxation treaty is between the two countries, we'll have that answer for you. If you are interested in looking at that for Mauritius, if you Google Mauritius and then let's say China double taxation treaty, there'll be a long list of what taxes you do and don't have to pay on there, and you'll find your answer.
Yeah. On a more general note, not depending on whether or not you have to pay it, but does it have a big effect on the end results if you are paying each year tax on that, on the growth? Is that
yeah, there'll be an effect, but you'll only pay. Well, it depends on which country, again, and what the taxation rules are. There will be an effect. I mean, the other thing that I've kind of left out of here is there's obviously charges with most platforms, most companies. It's something that it's an unavoidable cost, basically, that you'll have to pay at some point, whether it be tax, whether it be charges. So the way to kind of get around it is to look at the net growth. So to look at your growth minus your kind of charges and stuff, and then work off that basis. That's the easiest way to kind of look around it. You'll have to pay anyway, any way you do it, basically. Yeah. Whether it be taxes, whether it be charges, you'll have to pay somewhere. But what I always say is you're definitely going to be better off paying to do it than to not do it at all. If you don't save and you don't invest, a good thing that I always say to any client, especially if they're older, let's say they're 40 or something and they've never invested, and they say, oh, I don't want to do this, the charges are too high. Over the next 20 years, if I want to retire by 60, the charges are going to be X, Y, Z. I say, well, if you want zero charges, that's what you've done in your last 20 years. You didn't pay any charges for your last 20 years, but equally, what did you save in the last 20 years? And the answer is usually a lot lower than what he'll end up with in the next 20 years. So you're going to pay charges somewhere, but it's better paying a little bit of charges for a lot of kind of, well, growth or future money than not doing it at all, essentially.
Yeah. No, and exactly on Joe's point as well, on tax, it's important to speak to a tax advisor whenever you're looking at a situation, because everyone's situation is different. They're from a different country, they're living in a different country, may plan to go to different countries. It's always important to make sure that you're getting advice that fits your situation. And on that, actually, we have run out of time, Joe. So what I just want to quickly do is actually, because I know that a lot of different people got different situations. Joe, could you just turn your volume down a sec?
Sorry, I'll mute myself.
And obviously what you may want to do is get more information on what we've been talking about today. So if it's more information on any of the sort of the concepts and the ideas that Joe's spoken about, if it's more information about Providence specifically, or you just want to talk to an advisor and know more about actually putting this information into action. What I've put there is just different communication methods, different ways that we can reach out to you if you want that information. So feel free to fill that in just as I close out this webinar. So on that, Joe, I'd like to say thank you very much for your help and then your excellent presentation. And thank you.
Yeah, cheers. Thank you very much, guys. I appreciate you spending the time to join us. I know that you guys are allowed out in restaurants and bars and stuff like that now, so giving up your evening for me, I'm very thankful for that. I can't go anywhere, so I'm still in lockdown. So yeah, thank you very much for sacrificing your evening to join us. Cheers to that.
Thank you very much. And thank you to everyone who's attended. Thank you for your excellent questions, putting those in. And if you've got any more questions that you want to ask, Joe has got WeChat. So what we're going to do is we're going to bring him into the deVere webinar WeChat group, and we'll put questions to him in there. And if you're not in that group, please either reply to the email or the message that invites you to this webinar, and we'll bring you into that group. And that's where we discuss new topics and things like that. And we'd also like to say thank you very much for your donations. I know we're still throughout this webinar series, we are supporting Give to Asia. They're excellent work that they're doing on the front lines in COVID-19 response. So thank you so much for your donations as well. And we look forward to seeing you in 2 weeks' time for our next webinar. Thank you. Good evening.